For more movers, let's welcome in Diane King Hall, now host of Morning Movers, and a big move to the downside for Figma this morning in double digits, obviously off the back of its first report since that listing. What are you seeing there?
Mixed numbers and getting hit hard, as you mentioned, off the back of its first quarterly report card as a public company. So shares down more than 18% at the moment. Look, this one had a splashy debut when it came to markets. A lot of the IPOs this year have had a splashy debut, especially after 2 or 3 years of just, not a lot of momentum. To set the stage here, give you the background. Figma had gone public July 31st. It soared some 250% its first day of trading. Since then, shares have cooled. They're down from that high it saw around 143 significantly. I mean, we're looking at it down approaching $55 a share today. In terms of the quarter, they did beat on revenue, $249.6 million, just above that. EPS essentially broke even. The estimate was that they were going to pull in 18 cents a share, so that is much weaker than expected. It is an improvement from a loss that they had a year ago, but in terms of it, you have to perform when you come to public markets. You have to meet what the street is looking for at a minimum, right? Not just meet, you really have to beat. There may be some grace for a newer company in terms of beating, but they came in far short of expectations when it comes to profit. Again, at least they're not reporting a loss here, but still not enough to reach what the street is looking for. Their guidance is in line with expectations for Q3. Their sales outlook is between 263 million to 265 million. Their full year revenue, the outlook are looking for just above $1 billion. That's broadly in line with expectations. Investors are just underwhelmed today, Sam. So the risk here, analysts are flagging risk from competition, AI automation. Figma's honestly leaned into AI. That's one of the things that it's talked about in terms of its differentiator, in terms of its platform. You can build software off of it. You recall Figma was one that Adobe had its eye on before about absorbing that. That didn't work out, so Figma took its talents to the public marketplace on their own. On the first day, obviously it worked out, but today it is a big move to the downside and just takes shares under pressure more year to date.
Yeah, I mean, you raised such a fascinating point. I remember that day, as do you. I mean, there was just such a palpable energy here. Yes, they had the jackets. I mean, it was so much fanfare, wasn't it? But, to your point, obviously being such a newcomer to the market. I mean, this company's been around for a long time. And to your point also about Adobe setting its sights on this company, it was a $20 billion acquisition attempt. Yeah. There was a lot of excitement around a company like this, but clearly not enough analysts sort of covering this because it is such a newcomer, but also, to your point, setting such a high bar for itself as far as all that fanfare is concerned with that listing. You wonder what it means for some of these newcomers to the market with the IPO momentum now gaining traction.
There has been somewhat of a trend now, especially because, this was the thawing, beyond the thawing off period. This is the spring season for IPOs. We're going to see more. We have seen more year to date, right? And we'll see some more next week. Klarna's coming to the public market next week. We've got a few big IPOs happening next week, right? So it shows that there is a hot IPO market, but we're in the cooling off period in terms of performance, clearly, right? And Figma wasn't able to clear the bars when it comes to EPS, right? They did break even again. I want to give a nod there. No dog in the fight here, but, at least they broke even. But you're going to have to do better than that. They are above their IPO price, but far off the post-IPO high, right? So investors essentially assessing the growth story here. What is it? Does it justify the sky-high valuations that it had out the gate, right? And in terms of, as you mentioned, the analyst views, analysts are largely on the sidelines, which is not necessarily surprising with a newcomer because you do need a string of quarters to really be able to assess the financials, right? And know what are the metrics, the comparables that you should be looked at. B of A says, the near-term upside is largely priced in here. RBC says AI could be a tailwind. So but they do say shares look fully valued. You do have a lot of analyst activity around it today. RBC is lowering their price target. When I say a lot, relatively speaking, for a newcomer, RBC is lowering their price target to 65, so still some upside from here. Yeah. But they are sector perform, so they're neutral on it. Wells Fargo still neutral on it, equal weight on it. They have lowered their price target as well to $70.
Okay, and switching gears to HPE, up about 0.8% in what is largely a fairly muted day as far as the major indices are concerned. We set up ahead of that all-important data, but this coming off the back of its earnings. What are you seeing there?
So HPE did better than expected. They beat on both the top and a bottom line here. Adjusted EPS came in at 44 cents a share, clean beat. By a penny, but it's a clean beat. Revenue, $9.14 billion, also better than expected. The Street was looking for around $8.75 billion. So again, that was better than expected. Their guidance, they're projecting some more growth here. Their gross margin was up sequentially, but down year over year. Gross margin 29.9%. The Street likes that. Obviously, that means they have more money to play with. Essentially, they pulled in $1.6 billion from AI sales last quarter. They've got the backlog that's now at $3.7 billion. So it looks like, there's some strength there. More of their business, they say, is coming from governments and big corporations, which we know means it's steadier. It's more profitable. It's steadier, especially when you think about the deals with hyperscalers. Again, that revenue was a jump of 19%. So that's better than expected. Excuse me, I want to correct something. They did give a softer outlook for this quarter. That's just shy of analyst estimates. But they are being a little bit conservative because they're talking about the Juniper Networks deal, which came into effect in this quarter. There's a lot of noise on the floor. There's some applause happening on the floor, not due to HPE here.
I thought they were cheering your hit there, Diane.
In terms of the fiscal Q4 revenue outlook, they're guiding for $9.7 to $10.1 billion. The midpoint is below Wall Street consensus. EPS, they're forecasting 56 to 60 cents. That's in line with expectations here. So again, that reflects this conservative stance as they integrate Juniper Networks because, there's some bumpiness whenever you're doing an integration of an acquisition. They do expect that to deliver some cost synergies. We know what happens with cost synergy. That means there will be some, shifting of roles, reorganization, which means some people will move out.
Okay, and just moving on to Apple, obviously one of the saviors of the day yesterday. Shares a little bit under pressure this morning, but perhaps in line with what we're seeing across tech generally, but it has got an upgrade. Tell us about that.
Yeah, it's an upgrade for what it's worth. This is from MoffettNathanson. They've raised their view on Apple to neutral from a sell rating. They had a sell rating on this stock, but they're coming at least to the sidelines on Apple. They've got a $225 price target, which essentially signals a little bit of downside from here. In terms of why they're raising their view, they say the concerns about Huawei's China comeback and tariffs and the court case over Google payments, that's taken a backseat, right? So that's faded to the background. So they don't see the threats being challenging here, an easing of the threats, if you will. They think that, there will be some stabilization in Apple in terms of share losses in China, right? And in potential curbing of any anti-American sentiment there. The tariffs and court ruling, they think that's helpful. The court ruling, helps shield Apple, right? And then the exemptions that the government has done shields Apple from a lot of the tariff penalties. And those exemptions remind me of Trump 1.0, and there were carve-outs for Apple in his first presidency. There was a little, kind of prickliness around it this time around, but ultimately Apple's coming away with a win here. Now, Apple, this is where the MoffettNathanson see some challenges. They still haven't sparked this iPhone super cycle. There was the expectation last year that you would have this super cycle around the iPhone 16. Now, is it left to the iPhone 17 to do that, right? There's been all this pressure about where are you with AI. Apple's slow to, they want to come to market with a perfect or near perfect product, right? Yeah. So when they're in development mode, they go more quiet. They're not very loud about it. But with AI, we see there often is buzz or needs to be a buzz around it. Apple still is not there yet. We've seen some Bloomberg reporting around it today, around where it stands with AI, but we still haven't seen yet the super cycle.
That's right. I mean, they don't want to be sort of first with an imperfect product. They want to sort of give it some time and make sure that they come out with something good, to your point. I'm also seeing that UBS is talking about how the Apple App Store suggests that August revenue is up 11%. That was actually down from July. So they've been looking very much at what they're raking in from that side of the business. But remembering also Tim Cook going to the White House today with the other CEOs. So that's something to keep tabs on. But as you say, lifting the overhang, to Dan Ives' point, over the Apple stock with that Google development and also some of the China tariff stuff as well. Really good overview of Apple and also those other companies that we took a look at this morning. Thank you so much, Diane.